So, very happy now to introduce Edward Bell, Senior Director, Market Economics of Emirates NBD. Daejin Lee, Global Head of Research at FertiStream Freight. And Oddmund Føre, who's Partner and Head of Shipping Supply Chain Research with Rystad Energy. Now, it's fair to say that we sort of discussed questions about a week ago, and a lot's happened since then. And the last question, which I actually posed to them, I think I'm going to make the first question. And my question was, interest rates, global growth, nationalism, and isolation, or isolationism. I mean, we're basically seeing a bit of a change in the world order and economics not seen for 100 years. I mean, we've had 100 years of pretty much the same thing, and now it's all changing. So where do you think we're heading, and what is the outlook for interest rates, growth, and trade? Maybe, Edward, we can start with you.
Sure. That's a pretty easy question, I think, to try and encapsulate everything. But obviously, I think there's a split between what we're seeing in these kind of enormously influential economic decisions that are coming out from the United States with respect to tariffs, with respect to how they're going to treat their trading partners around the world, how the U.S. wants to orient its economy under this administration, and then also the market response to what we're seeing. So we always, take a big pinch of salt when we look at what markets are saying about the outlook for growth, about the outlook for rates or for currencies. I've done several presentations this week. I prepared some slides Monday, midday, Dubai time. Markets were projecting 6 interest rate cuts from the Fed midday. By the time I delivered the presentation, the next day it was down to about 3.5. So we're hugely volatile in terms of market reaction. But when you look at the sort of, I think, underlying story about global growth this year, it was due or was expected to be slower, but not necessarily a bad year for growth. The U.S. economy among the big developed economies was probably still going to be the relative outperformer, but not necessarily as good as we had seen in 2024. But some of the markets like the Eurozone, Japan, Eurozone and the UK, they sort of put behind the kind of soft performance behind them. It wasn't that they were going to be steaming ahead with great growth, but they were at least going to be positive. I think that story still holds true. It's a question of now understanding how serious are these tariffs going to be implemented. And I think for any of us to say with conviction, we know that for sure they're going to come back into place in 90 days, or you're going to have some deals or whatever. The US might walk away from them entirely to keep trading on a sort of pre-April 2nd kind of footing. That's a huge uncertainty. So the outlook there in terms of the impact for growth in the US for other big economies still remains hugely volatile. But from some of the key fundamental positions for the US economy, labor, inflation, all of them are heading sort of in the right direction that should allow interest rates to move lower. The prospect of more than 100% tariffs on imports of Chinese goods is a huge wild card. And I think already we've heard comments out from Fed speakers that the inflationary impact of that could last a lot longer. So we're not of the view that the US is going to tip into recession tomorrow, and that necessarily you're going to have the Federal Reserve cutting rates very steeply to help support the economy, but they're still going to be focused on those inflationary dynamics where the risks still look to be to the upside to us.
Okay, thank you. Daejin, any views?
It's interesting, as a researcher or maybe analyst, over the last 3 months, it's very crazy. So every time we make report, something changed. So yesterday I discussed about US tariff, and suddenly it's just paused 90 days. And how can you predict? So something important for us is that if you remember, as a normal consensus is all agree, it's more inflationary, right, because of tariff. And that means it's all agree going down in terms of trend of interest rate, maybe slow down to tackle the inflation. But problem is, it's all depending on what Trump act, but that is unpredictable. So something we need to agree is that, yes, it's going to be, how can I say, better economy in terms of inflation was expected, but not anymore. we say it's a very uncertain or concerning. So what it is meaning that everybody who plan to do something in next couple of months, all pause and wait. So, and on the other hand, next 90 days, who have any business with the US will be very act swiftly and move very fast. But it is all linking to interest rate, or maybe we say inflation is something different, right? Because of all those linking to tariff, which is unpredictable. Okay, but what we know is it's all play out over last I think 6 months. That report and White House announcement, executive order, all linking to what they say. We want to tackle some imbalance against China. So any other country just looks like open to negotiation, but looks like China, it's a little bit difficult to something we come up in the very short term. So that's why in just the conclusion that, yes, we all agree there are some inflationary pressure, but we know that there will be some kind of cut of interest rate in coming months or years, but could be very slow down. It's something we are now assess.
Thank you. Yeah, I just want to add, with some overall context and taking maybe 2 steps back again, because I think the interest rate is a big clue here. If you think about the U.S. right now, I think they're trying to rationalize what they try to do with Trump, and he's a businessman and all this, but what we're seeing now is rooted in some strategically big changes. We have a crisis in the U.S. economy. They have a deficit of 7% of their GDP. You have 130% national debt of that GDP. In comparison, in the EU before, you needed to have a maximum 3% deficit and 60% debt of that GDP to be part of the union. So that's a huge deal, and it's also been a lot of debt now on short term that's rolling over. The second big thing here is, of course, China. And you started to talk about the world order and how we know trade. We know that from 2001, China has been part of the trade organization, and we kind of, assume everyone plays by the same kind of free market rules, if you will, on prosperity. Whereas China might have a more predatory approach here. They want to grow, take market share. It's more of a superpower thinking. And so it's kind of, this is the overall setting. And I think this is also why we now see a lot of short-term volatility that they will accept in order to get rates down in the long term. And if you start to listen to Scott Bessent and a few that maybe sound more reasonable when they're underpinning arguments, I think that's a very big focus and a big change, and maybe a change of the world order we've known for maybe 40, 50, 60 years.
Okay, thank you. Let's dig a little bit deeper into the kind of whole tariffs thing. I mean, Liberation Day was 1 week ago, and since then, almost every day there's been changes. There seems to be, for those companies who have given a milder response to the US, they seem to be getting a 90-day kind of pause. China and the European Union, perhaps, and other countries which have sort of come up with their own retaliatory tariffs are getting a different treatment. But the question is, too, I guess, I mean, how are tariffs going to affect this area? I mean, the UAE and the Gulf more generally. And secondly, we go back to the US. I mean, do you think that this policy will, in actual fact, achieve what President Trump has in mind in terms of, sort of earning a lot more sort of currency in order to sort of reduce a deficit going forward? Edward?
Well, so on the first point, in terms of the impact of the tariffs on the sort of, let's say, MENAT region, so we can throw in Turkey and Egypt as well. All the countries across that sector, there's a couple in North Africa that had higher ones, had the sort of the baseline level, the 10% number applied to them. You could argue based on the way that the Trump administration, the trade representative presented their calculus for how they came up with the tariff rate that these countries charge on, that Saudi, the UAE, Qatar, et cetera, have all been very unfairly treated because actually all of the countries in the region import more from the US than they export. But when we've looked at the analysis across the region, the actual exposure to the United States as an export market, and a holistic one, not just from sort of a domestic good production, but also from a re-export market, which is key for the UAE, it's actually relatively small. So the primary connection between UAE and the US, for instance, is aluminum. And the US is a big market for the UAE's aluminum sector, or for aluminum producers, but in terms of aluminum exports to the US as a share of overall UAE exports, it's just 0.4%. So it's a relatively small number that we don't think poses a sort of economic risk for the UAE holistically. Yes, it's sector pain specific because those tariffs are also at the 25%, not the 10% rate, but not necessarily one that we think is particularly calamitous in terms of a first order impact. And that sort of analysis holds across much of the region. So for Saudi Arabia, the biggest exposure is through oil exports to the United States, again, not currently tariffed. For Egypt, for Turkey, it's through apparel and textiles, so getting that 10% rate. But again, they are sort of manageable levels in terms of the overall economic impact. Sector pain, yes, but economic pain, probably not so much. I think the big uncertainty is if we have a period of retaliatory tariffs like we've seen imposed from China, from the EU, and perhaps from others in the coming weeks, what happens to this region given that it actually doesn't have very high trade barriers with the rest of the world? Does it become an environment where goods flowing from China start to get dumped into this market, or the GCC market more generally? That's a concern, you know, prior even to Trump being elected, that we had been hearing from our clients that inflows of relatively cheaper goods coming in are sort of disrupting sort of legacy distributors in the UAE market. So that could be a little bit of an anxiety, I think. A good thing potentially for a consumer if you're getting a bigger pool of goods coming into your economy that could potentially be cheaper, but one for those sort of legacy operators in the region that could be a little bit more disruptive for them.
Okay. Oddmund, let's go to you.
Thank you. Yeah, I think to your point, the tariff question, like at the spirit, is not maybe the biggest concern right here for this region, and also this region is not a target from the US either. But it's also strongly kind of attached to the oil and oil price, which we look at a lot in Rystad Energy, and we have heard how Trump has been urging the region to pump more. We might get back to a drill, baby drill session later, but it's a desire to get more oil coming out, to get prices down, of course, taking the inflation down, again, back to the interest question. Then again, this region with all this sweet spot that they have, a lot of low break-even price fields at the wellheads, a region that we need to deliver volumes to meet demand in the many years to come. But at the same time, you also need to balance your stage sheet, right? So there's a lot of initiatives and ambitious moments going on in the region. So you will need to see also a certain level of that oil price. So I think that's more of a kind of relevant, or maybe more kind of a pressing issue. How will we see the oil supply and demand and the price playing out, which will really affect this region more.
Thank you. Daejin, you have any comment?
So it's interesting to ask a question after this kind of disruption from US tariff. How many of you plan to buy a new house in UAE? That's a very direct question, right? So basically, directly tariff, I agree, it's not really related to UAE or Gulf region. But indirectly, oil, yes, definitely, because Trump keeps saying, we will tackle inflationary issue by lower energy price. That's what he say. And also reducing sort of kind of regulation, efficiency may also do that. But more importantly, for UAE perspective, especially Dubai perspective, sentiment around new project, everything is quite difficult, uncertain, concerning. So it's a sentiment-wise, it's affected, not direct impact. And then obviously we all know, as economists or maybe analysts say, there's a likelihood a little bit difficult to say higher demand compared to last year in terms of oil energy is unlikely. There will be demand growth, yes, but we do not say it's a massive growth anymore because of this kind of transition period. So that's why we can say it's sentimentally a little bit difficult moment for tariff perspective in this region. But on the other hand, I don't know, it is important to know who is winner at this point, right? For this tariff one. Actually, India is somehow, and Brazil, something we say global south, excluding China. So it means Russia, India, Brazil, they all look like positive compared to any other countries. So that's what I may be starting with.
Okay. Another topic then, which is, we've been talking about it for quite some time now, actually since President Trump was elected in November, normalizing hotspots. And it's something he's putting a lot of effort into with the kind of Houthi situation in the Red Sea, and maybe getting the kind of the canal back into sort of regular running order. Also with the Ukraine situation, such that, you know, oil flows may begin again from Russia and stuff like this. So, I mean, in terms of that, you know, normalizing hotspots and things which generally have been good for shipping, if these things are fixed somehow politically, what might be the impact on trade and shipping, Edward?
Yeah, well, I mean, certainly we see the impact of the disruption in Red Sea shipping passing through to the economies here. We certainly had blips higher in inflation in the UAE as a result of goods taking longer to come into the market. So from a macro perspective story, things that sort of normalize shipping routes, but are not necessarily great for shippers or ship owners, benefit the sort of macro position of the story. So we don't take a view on how that kind of geopolitical developments will occur, but certainly if we look at the flows through the Red Sea, if they are sort of go back to kind of pre-conflict norms, again, a benefit for UAE, for Saudi. If we see less anxiety about Black Sea volumes as well, for key markets like Egypt, like Turkey, that rely on grains that are all the goods exports coming out from those ports, again, another positive. But it's still very much for us an open question as to are those hotspots easy wins or easy solvable issues for the presidency to get involved in?
So when we look into a little bit the next few months and few quarters, we always look into what is motivation and interest. So because of this situation, US perspective, the interest is enemy of enemy is friend, basically. So that means, you know, US does not really want to quarrel with Russia anymore, and then does not really want to do anything about something else other than China at this point. So something interesting, there are some rumor and news that Iran does not really anymore, you know, actively helping the Houthis and actively helping Hamas. That kind of rumor is coming out, and that is also back of that US neighbor ships is attacking them. So those kind of situation is, we don't know when it ends exactly, but the intention is somehow we know there will be some kind of conclusion, because the interest of the guys involving this situation is not anymore there. It's different now, change it. So that's why I believe somehow Red Sea situation is very helping actually shipping sector, inefficiency helping shipping freight actually, but that is not going to last the next 2 to 3 years. So it may be ended sooner than ever expected, but not next month, we cannot say. But within this Trump era, if he want to, how to say, tackle some kind of issue with China, he need to peace with the other enemies. So that is something concerning, and the motivation of the situation. That means likely we would maybe see something resolution, maybe not immediately, but it's coming some not nearly far away. So that's my assumption.
Okay, thanks. Oddmund, let's go to the next question, which is this drill thing. This what the president is saying in the US. He's very kind of pro oil and gas. How do you think this is going to affect the global oil and gas industry, and is it a serious setback for the kind of whole decarbonization and green energy process?
Thank you, and a very interesting question for sure. Yeah, drill baby drill. Still, you need market fundamentals, right? So he might remove a lot of hindrance or technical obstacles, but still you need to see market dynamics prevail for those barrels to come out of the ground. And sure, there is some setback on transition and on the greening of call it the world and shipping. But it's also somewhat more realism, right? So this is almost like a little normalization of hotspots as well. We saw the administration coming out with the new schemes and policies, where they, of course, will favor solar wind, for example, that is still in the money, more so than offshore wind, which is now coming to a stop. You also seen how when you talk about fuels for shipping, blue ammonia has been more attractive than the green ammonia. We know that this is more in line with the legacy of energy producers. You have a gas experience, and you can capture some of that carbon. Whereas the green ammonia is a bit more far out, fluffy, and something we more look at in Europe. So there is a big change here for sure. I almost want to also tie this to Europe and what we look at now, because we have a lot of internal barriers and policies that has been very costly on this green energy, which has led to the fact that we are, that's twice the amount of value and cost than, compared to the Trump tariffs. So that's also a place to clean up and move forward from where we are currently, and more trade that could also help shipping, actually. So yeah, we'll stop there.
Edward, do you have a view on that?
Well, I think from the, as you say, Trump is supposedly an ally of the oil and gas industry in the United States. I don't think anybody who's an E&P firm sitting in Texas or North Dakota is looking at the price moves of the last week and saying this is the work of an ally or of a friend. Huge amounts of uncertainty there in terms of what kind of investment plans can be made. And also if you have a maintenance of any kind of tariffs, hey, guess what? The oil and gas industry is a huge importer of capital inputs that are all going to be really expensive coming into them. And if there's also this inflationary threat from the tariffs or other policies about sort of labor markets that have been imposed in the United States, and that keeps interest rates not as steeply or not falling as much as perhaps investment would want. Those are all, I think, sort of some barriers for the industry in the U.S. at least. For the region, though, generally, the volatility that we've seen in oil prices has not been, I think, welcome in the last sort of 2 weeks or so, or the last week or so. We had been expecting that oil prices were going to sort of be lower this year than we had in 2024, but at levels that were not necessarily going to be too alarming for a lot of the big producers across the region, certainly not for the UAE. For Saudi Arabia, it is a little bit lower. And I think, of course, when you get this kind of volatility, there's always questions about what does that mean for the kind of scale of transformation that's underway in the kingdom? Can they continue to afford the projects that they have on the cards? Just to put the sort of context, the scale of project spending in Saudi Arabia is equivalent to adding essentially South Korea's economy on top of Saudi Arabia. So it's a huge amount. A huge part of it being financed by income from oil exports. We don't think necessarily that everything gets stopped or seized up because of the moves in oil prices we've had in the last couple of days, but there probably will be a delay or some slowing down of the scale of spending. And don't forget that part of the volatility we've seen was not just from the tariffs, but also from the OPEC Plus announcement that they're going to bring forward their production increases 3 months worth into a single month in May to try and increase producer discipline with hitting target levels. So it's not just the trade and the tariff story. You have also within the dynamic of the oil and gas producers in this part of the world playing into the oil price narrative too.
Okay, thanks. So last question from me. It's basically, if what we see coming out of the US is a signal of the slowing of globalization, because he wants to bring sort of production back into the US, how possible is that? I mean, what kind of scale can he achieve to make it a worry to shipping, do you think? Maybe Daejin?
Something interesting. I think everybody agree that there are problems in US because they are reserve country, that they have a huge deficit and a huge problem in terms of trade balance, yes. But we all agree it's very difficult to bring the manufacturing back to US in certain industry, like a textile, shoes, but we know that like a car maker or those kind of high technology could be come back to US. Especially we have seen that for this before this tariff announcement. Many companies need to say, "Oh, we will invest in your country. Please reduce something there." Means next couple of months, especially next 3 months, maybe we will see some investment kind of announcement because that's what they want basically. But not likely every manufacturing one come back to US because of inefficiency of the stuff and the high wage as well. And also it's very interesting. It's a very contrast to their policy on immigrant because immigrant with a low wage is normally how can I say supporting manufacturing activity. But when you look into Japan and Korea, which is also high, how can I say, wage, but they still maintain shipbuilding sector and also they still maintain car manufacturing. And maybe let's say we say now Tesla is there, right, in US, obviously. So yes, to some extent, indeed, we may see some investment, but we cannot say all manufacturing can come back. But I think what US want to do is that at least they want to produce certain amount of supply chain so that they keep saying that it's about national security. It's not about just the economy. So whenever war happened, like we have seen in Ukraine, Europe is almost out of manufacturing for many years, so they cannot compete kind of certain type of, how can I say, manufacturing war is basically. So that means the US also seeing that over the COVID-19 and then also this kind of conflict, they need to have some strengths in hand. Otherwise, when something happens, they indeed say in the report, can you trust your ally now in the difficult time coming? Can you really do that? So that's why, indeed, we will see some kind of manufacturing is indeed linking to their national security, like a car, shipbuilding, or those kind of steel. Likely, we will see something coming back.
Yeah, and they already started with coal, right? So it's back to the fossil fuel question. But you're right. I think that the shipping and the construction is a key element, and not only in the US. We see that in Europe and Norway. Politicians start to wake up a bit, and it's all back to this kind of security question. And we know, taking it back to the Second World War, we know that the merchant fleet, at that level was key for liberating Europe. But yeah, investments, I think that's a key question, and I almost want to take it over to the Gulf region, because what they're doing now will also favor this region, because here we have stability. It goes back to it's not a target from the US. It's a stable region. They have been strategically smart here to be neutral. They are mediating in conflicts and friction around the world, and it's likely that this region here is uniquely positioned to attract capital in the legacy sectors, but also in the renewable sectors and other sectors. As we know, this is a very ambitious region. So you can expect some capital to come in here, and this could be a very good region to be in.
A final word, Edward?
Maybe I'll take the opposite view and say I don't think that there was an economic emergency in the United States that needed to have tariffs and manufacturing return back to it. Manufacturing has declined as a share of GDP. Correct, absolutely. There's no dispute about that. But manufacturing has never left the United States. It's just sort of gone up the value chain. So if you look at what is being produced in the US, it is not, it's not Levi's or sneakers or very low value added products. It's very high value added products. And yes, I probably would expect to see more expansion and investment into those kind of sectors. Is that going to mean that manufacturing is going to be worth 20% of GDP, which it roughly was at its peak in the 1970s? I don't think so. The US economy has changed enormously over that period. And it's one where the labor market doesn't necessarily want to be going into a shop floor and manufacturing in terms of employment outcomes. If you look at the top 20 manufacturers in the US, their total employment, Walmart employs 6 times their total employment. So that is what the United States economy is. One, it is a consumption-oriented economy, and guess what? All of the consumption just got 125% more expensive in the last week. So that's going to be hitting what is the real core of the US economy. Improving manufacturing, helping to protect supply chains. I think these are certainly things that are all welcome, and no country around the world would disagree with them. But going about it with threats rather than necessarily opportunities is probably not the right way to go about it, and is getting the kind of reaction or response from countries that had thought they were either trading partners or longstanding allies, or if you look, you take the example of Bahrain and Oman, 2 countries which had free trade agreements with the United States. guess what? Now they're being imposed with 10% tariffs. So how strong are your trading links with a country that wanted to push out these free trading deals and is now ripping them up?
Thank you. We have time for 1 or 2 questions from the floor, if there are some, please.
Thank you, Kevin, for having a good and great start of the day. So I am not going to ask any question about Mr. Trump. So my question is about China and deflation. So how do you see the China, the major issue is the deflation. Do you see with this all this tariff, there is some advantage or some improvement in long run with the supply chain disruption or maybe more tariff on Chinese product, please?
Well, so look, China is in a economic crisis of confidence, right? So it's been hit hard by a slow motion property crisis. Consumption has been very deflated since the pandemic, and the steps that the government took last year to try and support the economy, they didn't deal with sort of the underlying issues that would help to improve consumption, help to improve investment. And I think the idea that suddenly, your biggest trading partner is imposing these major trade barriers on you, and so you have this, already a surplus of production capacity in China, and now you have a reduced export or a reduced demand for that surplus capacity. Does that make the deflationary problem perhaps even worse in China's economy? We were quite anxious about China not necessarily taking away from global growth this year, but not really adding to it in a material way. And I think our expectation or the idea that you get these large-scale fiscal stimulus programs where you start to have massive construction across China's economy, it starts to hoover up goods from around the rest of the world. I don't think that there seems to be any appetite for that from policy statements that we're seeing from China's economy. So the kind of drifting and deflationary environment that I think we've been in for a long time in China looks like it has not been resolved yet.
One more question? Yes, sir.
Where do you see the US dollar exchange rate go in the next 9 to 12 months, and why?
That one's for me. Yeah. So for any, I mean, I think I've done this event a few times in the past where I've had to, put my money where my mouth is and talk about oil price forecasts, and hopefully they're not going to be put up on the screen behind us to say whether they were right or wrong. But we've had a dramatic shift, I think, in expectations for currency markets. November, December last year, euro at parity was a done deal. It was not a matter of if, it was a matter of does it come at the end of 24, end of Q1 25. But there has been a dramatic reorientation in terms of expectations about currency markets. So if we take euro dollar as our pair, as our sort of signal one, it does look as though the dollar starts to soften off against that. We're already at the sort of 110 kind of level, and the idea that we could get even higher, maybe even 115 by the end of the year, I'm not saying that's necessarily a core forecast, but I don't see necessarily why you would stand in the way of that kind of an expectation. And that's being driven both by US issues as well as European ones. So if we look to the European market, quite a lot of enthusiasm about Germany sort of finally waking up to do what it should do and be the locomotive of growth in the Eurozone economy, start to spend much more and start to shed off this idea of fiscal responsibility is the only responsibility of governments, but they should actually be investing in their economy in a productive way or investing in making up for the defense industry, which have been sort of lagging a long time. And so that's prompted a reorientation about what does growth look like in the Eurozone, and that the European Central Bank perhaps does not need to cut interest rates as much to support the economy if you have a strong fiscal bid for growth. At the same time, anxiety about recession in the US has increased. And now, while we don't think it's necessarily going to materialize imminently, the threat of it plays out in currency markets, and that's what's prompted the US dollar to be much softer. Is the idea is, okay, the Fed is going to have to come in and step in to support the economy with much steeper interest rate cuts. Again, it's not a view that we subscribe to, but I think that's what we're seeing played out. So a relatively lower dollar against some of its key trading peers, euro in particular, sterling, sort of a similar kind of story, although probably the lingering effects of Brexit playing out more obviously now in terms of the nature for the US economy, and then against currencies like Japanese yen, which had been, in our view, probably overly undervalued in the last couple of years, and the Bank of Japan being the last one standing in terms of interest rate hikes. Looks like the Japanese yen, again, performs stronger against the US dollar this year. More of an open question for emerging market currencies, as many of them will be more acutely hit by the effect of tariffs. So we've seen Indian rupee sell off quite a bit this year. Chinese yuan, of course, not quite as freely responsive to economic dynamics, but one that I think will be used by the Chinese authorities to try and offset the impact of the tariffs. So again, sort of developed markets, US dollar relatively softer, but perhaps against emerging economies a little bit stable, if not a little bit stronger.
Okay, just to finish then, a very quick one. I mean, I think we all agree short term everything is pretty chaotic. Longer term, are we pretty optimistic that things are going to settle down? I mean, kind of a yes or a no, Oddmund?
Yes.
Okay, Daejin?
Sorry, no.
No. Okay, Edward? Okay. Thank you very much. Thank you.